Welcome to the first video in our series of video tutorials on risk management. Through these tutorials, we aim to help traders better understand and carefully analyze their trade activities, keeping in mind proper money management. Just to get the gist of whom we are pitted against in the Forex markets, we begin with identifying the various market participants. Forex market participants are broadly classified into the big players and the small players. Big players are the big banks, such as the central banks of different countries, or large investment or commercial banks, besides the large corporations and hedge funds. These are the strong players, trading day in and out, who know the ins and outs of the market. Their purpose of trading Forex ranges from either hedging their currency exposures, resulting from various investments or imports or exports, or to profit from the interest rate differences through rollovers or just merely speculation. Then we have the small players. These are the retail traders like you and I, as well as the Forex brokers who help these retail traders connect with the bigger players out there. Hence, we are pitched against very strong market participants, and so it is important for us to learn to survive these markets before being able to earn large profits. The first step for this would be to identify some of the common mistakes which traders often make so that we can work on those areas. Some of the common mistakes that we identify are as follows. First being the lack of knowledge and experience. Then we have the lack of a proper strategy or a trading plan. Flawed money management, transaction costs, over-leveraged accounts, over-trading, and finally, human emotions. The biggest reason why most of the traders often lose money in Forex trading is their lack of knowledge and experience. One cannot afford to risk all the hard-earned money into something that he or she does not understand. Hence, it is important to get the basics of the Forex markets correct. One should have proper understanding about how Forex markets work and its basic terminology. Having done that, it is important to identify the trading instruments that you're interested in trading and research well about them. Learn to acknowledge your doubts and address them before going ahead on live accounts. It is always best to test yourself and your trade strategy on a demo account before getting onto the live account. And it also is important to familiarize yourself with the trading environment, the trading conditions, which greatly affects your trade execution and in turn the trade positions initiated. The next reason for the failure is the absence of a proper trading plan or strategy. An informed and disciplined trader always stands a better chance of being profitable in the long run than a rogue trader. Therefore, it is important to have a proper trade plan and to be informed about the various news events which can have an impact on the trading instrument in consideration. It is important to set targets or goals as part of your trade plan. One can never earn long-term returns without a proper trade plan or a strategy. Beginner's luck might work, but will be very short-lived. Having a trade plan is good, provided it is a well thought and carefully prepared one. A flawed trading plan or strategy is no good than a gamble. The next common mistake we will be discussing is flawed money management. Prudent capital management should be the most important point to consider while developing a trade plan to protect your account from big losses. Money management helps one to limit the losses. It is a safeguard to protect your account balance and yourself from risking too much. It helps the trader to grow profits in a stable, consistent, and a sustainable manner. The fourth most common reason for losses is an over-leveraged trade position. Leverage, as we all know, is a double-edged sword and can work both for as well as against a trader. Therefore, it is important that one uses the leverage smartly to his or her advantage. Do not get tempted with a high leverage available. It is important to choose a reasonable amount of leverage according to your risk appetite. Leverage can be a powerful tool to maximize your returns, or it can also be the major reason for the downfall. Hence, one should use it wisely and sparingly. One of the most trivial reasons for losses is the tendency of a trader to overtrade. There can be various reasons for overtrading, such as the excitement for trading or revenge trading to make up for the past losses. Revenge trading is seen as the most common reason for a trader to overtrade. Remember, one can never fight against the market. Then often, missing a forex trade and then chasing the market is another reason which leads trader to overtrade. And finally, the most important is greed. The greed of earning more in case there have been profitable trades is another reason that a trader often overtrades. These excessive trades mostly end up going against the trader, resulting in bigger losses. Often, traders even scale up their trade positions out of greed to cover up the losses in revenge trading that further adds fuel to the fire. Another important and often ignored mistake of trading is ignoring the transaction costs involved. As you might have noticed, at the onset of every trade, a trader always starts off negative. This is the result of the spread, that is the bid-ask. A retail trader always pays the bid-ask spread. Additional charges from commissions or swaps for keeping positions open for more than one trading day can also be incurred and should always be taken into consideration, especially for scalpers or intraday traders who tend to trade large volumes. Trading cost makes the odds of winning considerably less for a trader. It is always advisable to backtest and forward test the trading system over a sufficient amount of quantifiable data to analyze the costs involved in the trading plan. And finally, the last most common reason for a trader's failure is the human emotions involved. As part of behavioral finance, it has been found that emotions of fear, greed, overconfidence play a very important part on the psyche of the trader and hence impact his trading activities. It is of utmost importance that a trader is able to accept and handle his losses. Only then can he begin to recover them. Finally, to conclude, it is all a mere fight for survival. The first aim of retail traders like us should be to survive these markets where we are pitched against much bigger and stronger players. As a starting step, one should focus on ending the trading account either positive or flat, including the transaction costs involved. Try achieving this for at least 3 consecutive months before shifting the focus on scaling up their trade positions to earn bigger profits. This is just a stepping stone in the longer journey to follow as a trader. Hope this tutorial would make you reflect back on these common mistakes that we discussed and will help with the trading. Thank you again for taking the time to watch this video.